Hello, fellow traders. 'Tis I, the Rumpled One. It is Wednesday, July the 14th. The year's 2021. Let's talk trading. Line in the sand, part 3 is for educational purposes only. Your results may differ from mine. So, yesterday we had Walmart on board. I can't make it today, but we can continue talking about line in the sand. And if I remember correctly, uh, Walmart was sharing with us his opinion and his views when we're looking at the Walmart lines. Now, I had shared with you the buy zone, and I think what we should do today for line in the sand is let's talk about the wick zone. And I think we also talked about the rat zone, but I'm thinking maybe I should do them separately, just that so nobody out there gets confused. So we're looking at the wick zone here, and just so you know, this is a 2014 indicator. But if you've got the 2014 donational indicator, but if you have my TRO HL5, you can also use that to display the wick zone. So let me see. Is this the wick zone or is this the rat zone? Let's see. This is the wick zone. So you say shade wick zone true. And of course, show lines true. Show high and low true. Show top and bottom true. And then you turn the rest false. Then what you do is you come down. My period is 1 day. My bars is 1 and my shift is 1. So you'll be showing the high, low, top, bottom of yesterday's candle or the previous day's candle. So that's where you can see the red there and the green here, but the rat zone is in the wick zone. And that's why I want to do them separately, so and then we can combine them. So we are looking at the wick zone right now, and the thing about the wick zone is price does not like staying in the wick zone. So you see here, when price started out in the third hour, actually and even in the first hour today, it dipped down into the lower wick zone, almost broke the low, came close, but no cigar. But then it came out of the wick zone and it's run all the way up. So you see here, if you would have went long at 06 and you stayed in there, you'd be up over 80 pips at the moment. And actually, you had a chance to get out at 89 or 90 each of the last 3 hours. And then you see here, price not wanting to be in the wick zone, and it came back out. Then it went in, and you see it didn't want to stay in the wick zone. It came out just a bit, but it did come out. That's what you have to understand. Sometimes you get a little, sometimes you get a lot. And in this case, there's about a 20 pip run to the south out of the wick zone. And the wick zone is a breakout trade. In other words, price gets into the zone, so you look to go long at the previous day's high, or short at the previous day's candle top. And without looking, because this is dark red or maroon or fire brick, I forget which color I use, yesterday was a down candle. If these zones were green, then yesterday would have been an up candle. And that's simply, so down here, you go long at the candle bottom, or you go short at the previous day's candle's low. Real simple trade. And so that explains the wick zone. Now, let's look at Oh, and one thing about the wick zone, see, once these lines are put in, they don't move until tomorrow. Then you get a new set of wick zone lines. But for the entire trading session, these lines are drawn in the sand, and that's it. They don't move. You can trade them if you get the opportunity. So we've talked about the buy zone now, and we've talked about the wick zone. So let's talk about the rat zone. Now, the rat zone, I'll put the H1 candle on so we can kind of stay consistent. These lines move because we're working with today's data. We've got the high and then 20 pips off the high. We've got the low and 20 pips off the low. If price makes a new high, it's going to move this dot up and it's going to move the zone up. So the rat is dynamic. So you'll never actually break out of the rat zone to the north or to the south, because rat's reversal trade. So this is the trigger line. So when price is up here, this is when red rats look to go short, and prices in here, this is where green rats look to go long. You might ask, well, why wouldn't you take this trade? Because it's not a rat zone trade. It's some other trade. So if you go long here, that's not a rat zone trade. It's a rat's only reversal. You can see here the rat zone indicators telling you that the rat zone's large enough. And just so you know, that's just a TRO, rat zone indicator. It's not a donational. So keeping in mind, why do we do the rat zone? Well, once again, statistics show usually the distance between the high and close is greater than 20, and between close and the low is greater than 20. And you've seen that in the charts I usually put out at the beginning, or the videos, the weekly open and gap, and then the weekly wrap up. I usually show the ranges for the days, week, and month. And as you can see here, the magnified market price is showing you it's 5 pips off the high, 86 pips off the low. But remember, the distance between the high and the low, or the range, needs to be large enough. And that reminds me, I still need to make an update to this indicator so I can give the traders more control when this actually triggers. I think the default in the indicator is 40. I usually like to wait to see at least 60. And as you can see, price is pulling back. Now, trading the rat zone, I usually don't use the H1 to trade it. I'm usually using either M15 or M5. And you can see here, we look for these reversals. So now we've discussed the buy zone, the wick zone, the rat zone. So what I've done on this one chart, if I can find it, we've got the rat zone and the wick zone combined. So you can see here the rat zone, we were using the TRO HL5 indicator to show the rat zone here, and one to show the wick zone. So you can see here, got rat and wick overlapping on both sides. So if you look at a daily candle, you can see why. This candle right now looks like it's an inside bar. So that's why those two zones at the moment are overlapping. So lines in the sand, how do you use this? Well, if you notice here on the close, on this showing the close, you can see I have a percent ATR, and that's ATR from the open. So usually price will get to 50% ATR from the open and start to reverse. So remember, we talked about the buy zone or the daily, weekly open crossover, monthly crossover too. So that's the distance. So usually when prices are, if you're doing say a buy zone trade and you go away and you see we're about 50% of the ATR average true range away, what you might want to start thinking about is taking your profit. And when you see it around, 80% or above, that's when you start thinking about reversals. So in this case, you'd be looking to come out of that rat zone. The red rats would start shorting. And you can see here, I think when we started, this number was 5. So we've moved 6 pips away from when we started, or 10, 11 pips now away from the current day's high right here. So once again, running those frequency distributions on the ATRs to see where do we want to exit or where do we want to think about entering. So once again, you've got a wick zone trade that you want to take. You've got a rat zone trade that you want to take. And since this candle closed, or the previous day closed red, so this was the previous open right here, and this was the previous day's close right there. It's even labeled because C, bottom, open, top. So for the open and the close. So the previous day's close is usually close to the current day's open. So you can see here, this was also a buy zone trade. So you had one of those combos where you had a wick zone trade, you had a rat zone trade, even though at the time the rat zone wasn't a valid trade, but you knew at some point in the day this might be the rat zone. So wick zone, rat zone, buy zone, all working in your favor. So once again, rat zone's a reversal trade, usually later in the day, usually sometime after prices moved about 40 to 60 pips. You start to look for that reversal. And does it work every time? Of course not. And you can see here I actually have the wall mall lines on for this hour. So price this hour opened here, came all the way down about 10 pips, and then reversed and went up. So trading either short or long this hour would have paid off. You had the open at 79.9, call it 80, high 91, low 71. There were pips to be had. And you can see it right here. So for some of you, this might be more than you can handle, trying to look at 2 or 3 or 4 different methods all in the same chart and making heads or tails out of it, or really making money out of it. So whichever of those methods, if any of them, suit your personality, how you think you'd like to trade, just use those methods, because once again, statistically proven, and it's up to you, because somebody had posted something about, talking about a back test or results. But the thing is, the method has the statistics to back it up, but you, the trader, have to do the work. And that's just something that some traders just don't seem to get, that you have to do the work, because it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.